Up next, we have the Fiduciary Duty and ESG panel. ESG, sustainability, and impact investors will share their views on the evolution on their space in the private and public markets. They will share their experience in how they measure, categorize, and include it in their due diligence. Moderating this panel, we have Franklin Mora, Investment Principal at Open Road Ventures. Please take it away, Franklin.
Thank you, Claudia, and thank you everyone for joining. I'll ask all of our panelists to turn on their cameras. This will be an hour-long session. We hope to make this an interactive discussion amongst not only just the panelists, but also people who are listening in. And so I welcome everyone to send along any questions as you're listening to the discussion, and I will gladly chime in and interrupt some of the panelists with some of those questions so that we can make this as interactive as possible. To get us started, as Claudia mentioned, my name is Franklin Mora. I'm an investment principal at Open Road Ventures and Alliance. We're a private debt impact fund providing short-term bridge financing across sectors and geographies. I'd like to welcome our panelists also to introduce themselves. I'll ask each one of you to do so, just to say a bit more about your role, your firm, what you do. And to just kick us off, the topic is fiduciary duty and ESG. And so along with your introduction, if you can just say, how do you define ESG investments in your line of work? And how do you differentiate that from impact investing? That'll kick us off. So with that said, I will ask Yvette to start us off, and we'll go down the row of this panel.
Thank you. Hi, everyone. I'm Yvette Elizalde. I'm a research associate at Meketa Investment Group dedicated to ESG strategies and diverse managers. For those of you who are unfamiliar with Meketa, Meketa is a 100% employee-owned firm, investment consulting firm, with a suite of services ranging from private markets consulting, general consulting, and OCIO services. We serve a diverse range of institutional investors and have 1.7 trillion in assets under advisement across 200 clients. And so I say all that to kind of preface my answer on how we define ESG investing. With over 200 clients, we don't have a clear, strict definition on what ESG investing means to us. We kind of educate our clients on the different components of ESG investing and allow them to kind of set their own objectives, pick their values, and then kind of create the direction. And then we kind of follow up with the due diligence and then selecting appropriate options for them. And we educate them on the different types of ESG investing, meaning whether it's ESG integration into the research process, best-in-class screening, exclusionary screening, or if it's just the ability for a manager for a manager to have engagement and influence change. And the last question, I believe, on impact investing versus ESG investing. For us, ESG investing can be strictly financial as a way to generate alpha or for risk mitigation purposes, whereas impact investing, it's more values driven. You're trying to create meaningful change while also still outperforming your benchmark. So that's kind of the way we differentiate between those two.
Thank you, Yvette. I'll pass it on to Ekaterina.
Thank you very much. My name is Katerina Gradovich. I work at Bank of America within the CIO office, doing due diligence for sustainable strategies. And this is my focus. So pleasure to be on this panel. So in terms of how do we define ESG, we actually have very rigorous internal standard. And there are 2 points to it, which are not necessarily connected to ESG, but rather maybe all investments in general. It's intentionality and consistency. So when it comes to intentionality, it means sustainability has to be integrated into the process, not when it is convenient, but rather like intentionally, the managers have designed the process of how they are analyzing the exposures, either risks or opportunities. And consistency means that every single security that goes into portfolio has to be aligned with that process. In terms of how do we define ESG and the difference in impact, here we're somewhat similar to what Yvette was saying. We don't think there is one approach that would fit everybody. There is definitely a range of how sustainability can be integrated into the individual portfolio, but also in the overall client portfolio. We have actually developed internal framework, which we named ABC, and it stands for Avoid, Benefit, Contribute. I think it's somewhat similar to what other panelists will discuss, but basically there are three main categories of investments where you can apply exclusionary approach, which used to be historically the main one, where SRI investments were starting point, right? Then benefit, where you would seek how you can improve practices or policies, as well as the products and services the companies produce. And contribute is really where you focus on solutions. This is where the impact investments would fall, right? And so we believe each client can choose what fits best their needs and their values. And then within each one, of course, of these approaches, you can also prioritize different themes that are important to you.
Thank you, Katarina. I will pass it on to Sarah.
Hi, everyone. My name is Sarah. I use she, her pronouns, and I am the head of research and education at Novata. Novata is an ESG data platform for private markets. And so we offer our clients three things. One, we help them identify what metrics are relevant and that they want to be collecting. And we help them define them. Two, we provide a platform to be collecting that data. And we provide, so right now, our main customer base are private equity firms who want to be collecting data on their portfolio companies. And so we provide the portfolio companies with guidance and support on why is this metric relevant in the first place. So it's just, humanizing and explaining what this ESG metric means, and then giving them a step-by-step guidance on how to actually collect this information. So who within the organization would be holding this information? How do you calculate it? And we try and provide standardized ways in collecting the data to kind of fight against the fragmentation that currently exists in the space. And then the third thing that we offer are benchmarking and analytical tools. So for folks to be able to assess and analyze performance on the ESG metrics that they deem to be relevant to them. And so I think the question of how do you define ESG investments? I think that everyone is kind of touching upon it, but to kind of put a term to it, there is no one size fits all. So everyone has their own ESG strategy, and that is catered to their values and their needs. And so I think that that's where Novata kind of fits in, which is helping folks identify, well, what is that specifically? What does it mean in terms of the actual data that you want to be collecting? And then how do you analyze it and track progress year over year and see how you're contributing to these major societal issues? And so I think in the distinction between ESG investments and impact investing, I think we all understand that those are two separate things. And so within our platform, we offer the ability to have an impact investing module, which is focusing more on what organizations do as opposed to ESG investment, which is assessing companies on a set of ESG policies. So our platform is designed to be able to answer to both. And so I think that's me in a nutshell on those two questions. And I'm so happy to hear.
Thank you, Sarah. I will pass it on to Lisa. If you can introduce yourself.
Hello there. I'm Lisa Morales-Hellbo, and I have, 27 years as a serial entrepreneur, recovering and yet still simultaneously an entrepreneur and VC. I'm co-founder and GP at REFASHIOND Ventures. We currently have a rolling fund that invests across supply chain innovations. The categories are data, AI, advanced materials, advanced manufacturing, and advanced logistics. our rolling fund has done 16 deals since last July, and we are currently raising our first institutional fund. We see ESG and the climate crisis as being the opposite side of the same coin as supply chain. Personally, I really think that we've been over-indexing for superficial report cards on ESG, and that we really need to get more systemic in paradigm-shifting, impactful, real, long-term, harder to have easy, quick fix measurements on types of shifts. And those are foundational within our systems and supply chains. 3 of the 4 categories that we focus our investment on involve physical atoms, because we're not going to decarbonize the planet with software alone. We do have a proprietary scoring rubric for our investments, which include ESG, impact, diversity, alongside the more traditional investment criteria. But longer term systemic design thinking, we believe, is required to actually intentionally architect the outcomes that we're creating and willing into existence through this intentional investment and support of emerging technologies. I think a lot of the current paradigm, the definition of insanity is doing the same thing and expecting different results. We have a billion-headed beast of our supply chain infrastructure that is a $100 trillion investment opportunity. And an HSBC and BCG report recently came out stating that we do need to fully replace the entire $100 trillion global infrastructure of GDP to be able to hit the sustainability goals that we've set for ourselves, so that we can continue to exist on planet Earth. So it's a big undertaking. It's not going to happen incrementally, and it's going to require a lot of capital. And more importantly, investors that understand the systems and have focused, specialized, dedicated expertise in this space.
Thank you, Lisa. Rob, I will not last but not least, I'll pass it on to you.
Hi, thanks. Good morning, everybody. So I am an Australian living in Canada, joining a session in the United States, so happy to be here. I work for family offices with investments, have advised multinationals and pension funds, private equity, development firms, and small, medium-sized companies. My focus and my expertise is due diligence and risk. The way I see ESG is basically evaluating a company based on how they manage and measure their internal risks with regards to laws, regulations, and industry best practices. And if they choose to do better, that could be positive, impactful. So when I do a due diligence on a company, regardless of the size or geography where it is, the only way really to benchmark anything is to do it on laws, regulations, and industry best practices. And you can quantify that, obviously. And you can measure it and you can benchmark that. With regards to impact is a choice. It could be positive, it could be negative. I think everyone here wants everything to be positive. But if you want to make an investment on something and you have an objective, you can filter out any investments or potential investments based on certain positive outcomes that you want to participate in when you put your dollars in, and therefore make that work. But that's, to me, the difference between ESG and impact. ESG is an internal management framework and tool to manage the risks of a company. And an investor can look at how that is done and evaluate if they think it's been done properly or not.
Yeah, thank you for that, Rob. And I want to continue on that point of measurement. And maybe we'll start it off by thinking about it in 2 ways. One, in the private sector, and then we'll move into the public. So maybe this question is a bit more on the private side. And so I'd love for both Sarah, Lisa, and Rob to discuss, how you think about measuring impact in the companies Sarah, you probably are looking at it from the perspective of measuring the impact that the portfolio companies of some of these funds. And so, is there a streamlined way? Does it have to be by sector? Maybe you can give us some of that. Lisa, if you can answer the same question for some of the portfolio companies that you invest in, just an example of how do you measure that? And Rob, likewise, as a third party doing the diligence on them.
Well, thank you for that question. So I think how do you measure impact could be a whole session in and of itself on multiple conferences. I think I think for me, it is really, you have to be looking at it at a sector specific, industry specific level. I think that it's interesting because GPs have a broad range of companies on their portfolio. And so you kind of have to have that dual lens of, as a GP, where do you want to stand on ESG? And how do you want your portfolio companies to be standing on these issues? And so I think that there's a dual lens through which you want to be assessing it. I also think that you want to be looking at where the organization is at today versus, or where portfolio companies are at today versus where they can be, and how you can actually track progress. Because I think that we're welcoming everyone to the party, the ESG party now. And so having this expectation that folks are excellent at doing ESG would not be a fair expectation. And so I think really giving an honest assessment of where you're at today versus where you want these organizations to be is perhaps the best way to measure impact. Is what is the ability to change and do better. And so I guess that's how I would encourage folks to be measuring impact within their portfolio companies.
I'll jump in. So for us, we invest early stage, pre-seed, seed. And for us, going from 0 to 1 starts with intention and your core values and culture, which we also score on our rubric, because it really comes from the top down. And you have to set your intentions from the earliest days of forming your company and culture to be able to have it permeate through all your additional future hires. And then it comes down to governance. I think that a lot of Silicon Valley companies, generally speaking, lack a lot of the governance that they truly need to not only hit sustainability goals and to measure and track them, and but with diversity, we haven't really had any real impact or change in Silicon Valley in diversity numbers, despite billions of dollars being thrown at the problem. It really isn't something that they're trying to solve. They're just trying to throw money at it. So that happens a lot with ESG as well. If we enter into this ESG and sustainability theater, where it's a marketing exercise rather than foundational to your company's culture and values.
It's interesting. So ESG in impact and how do you measure this? So it really depends on what we're talking about. So ESG is, environment, social governance. Within under each one of those, it could be, for example, social could be employee engagement, it could be equality, rights, and accommodation, it could be philanthropy, it could be training and career development, it could be digital innovation, it could be workforce diversity. I mean, it really depends on what we're talking about, right? If you're a smaller company, diversity inclusion is probably not a very big thing if you're a company of 5 people. If you're a company of 500 people or 5,000 people, then yes, absolutely, it's something that is quite relevant. So it really depends on the context. It depends on the geography, the industry, the size. It's not a one size fit all. And that's one example of what I explained, and how you can take one thing, diversity, inclusion, see if it's actually relevant or not. And you can do that with any other of the individual variables for ESG. With regards to impact, so diversity, inclusion. If I'm an impact investor, I'm looking at a startup, and one of the things that I want to make an impact, a positive impact in society is diversity, inclusion, and I'm investing in a company that has 5 or 3 people, well, is it much of an issue today? But if that company, I think, can scale and grow quickly over the next 3 years from 5 people to maybe 500 people, then I do the due diligence with the founders and I say, what is your process today? But more importantly, what is it going to look like in a couple of years when you scale? What are you going to do? What's your methodology? How are you going to deal with diversity inclusion? Does it mean anything to you? Do you actually understand that if you do that, you're actually going to make more money, or maybe save money, be more efficient? So that's how I see it.
Yeah, thank you for that. I mean, to think about those things, I mean, there's a difference if it's depending on sector, stage, what is being measured. Lisa, to your point, I think there's a determining some qualitative factors in some of these companies of what the values are, so that to make sure that it's aligned in the future. That's helpful to think about when making some of these investments in the private markets. Curious to Yvette and Katarina, as you're evaluating in the public markets, I think there's been a lot of news, obviously, of greenwashing lately from banks. We saw a scandal happen earlier this year with DSW, and there's obviously been a huge push of doing a lot more of marketing of ESG funds. So, in your experience, how is it being marketed differently by companies, by fund managers? And is there any way that you would categorize ESG specifically? Like, would you put it in different buckets? So curious of what you've seen in public markets.
Sure, I can start here, and maybe I'll add on a little bit more on the metrics, because it relates to this question as well. Similar to what Rob was saying, right? Like, not same metrics could be applied to every strategy. So while we do expect the strategies to report on their metrics, and we also have developed the system of monitoring that ourselves, if you look for environmental strategy, maybe they will not do as great on social metrics. At the same time, if the strategy is focused on social metrics specifically, right, then maybe some of the environmental will not be as of much of a priority for them. At the same time, often you see that companies that have great culture and are focused on being just better run businesses, just as Lisa mentioned, right, like they will actually do well on the majority of these metrics. Not to throw shade on the ratings, but with ratings, they focus so heavily on the policies, right? And we all know certain policies, they don't necessarily result in the change of how the companies behave, right? And when you hire somebody to be a sustainability manager, that's oftentimes the first thing they do. They'll write the policy. Oftentimes, these policies may just basically restate the law, right? It's illegal to discriminate, right? But then when you have this anti-discrimination policy, you will get the check mark that here you get extra points for your rating from third-party data provider. And that's why we don't necessarily look at the ratings. It doesn't form our opinion, right? But it's not something that we will abide by. That's if something is AA rated, this is a good ESG company. We all have seen oil companies or tobacco companies have good ratings because of the governance. So we take it a step further and trying to analyze, and this brings us to the question, how do you really measure impact? Here we see, because we look at the investment strategies, right? Like, what is the objective of the manager and how can he support that he is achieving that objective? Like, is the objective for the portfolio to be aligned with maybe 2-degree scenario, right? Then they have a methodology to calculate that. Even better if they have somebody to verify that. And now there are more companies that do verification both in public and private markets. Another thing, like, we will probably see more standardization, hopefully, when it comes to metrics, not necessarily more standardization, at least in the United States, when it comes to the ESG strategies. Like you mentioned, in Europe, there was a scandal. So they did develop the framework for sustainable strategies. And now there is a very strict system of how they defined each type of sustainable strategies. Here, we probably won't see that, but we might see some better progress with the metrics. And maybe one other thing I'll add, like just for people to understand how complex it can get, it may be easier to measure some metrics, but with some metrics, for example, when we come to healthcare, right? Like what often is getting measured is not healthcare, but really sick care, because people count how many hospitals they have built, how many patients they have catered. But really, if you provide good healthcare, you should have fewer patients every year because you prevent the disease, right? Like you prevent people from getting into serious trouble. And so how to measure these things, it's not that easy. And some managers come up with their own ways, especially in private sector, to figure out what's the best way to communicate. Similar with emissions avoided, right? Because is it an additional thing that you avoided, or is it something that was in the progress already? So like, are you creating the impact, or this was just you selling out an assets because it was not anymore economical to run that factory maybe, right? So it is in some cases, case by case, it is complex, and luckily, there are many data providers now who can help us solve this. So
and before we jump to Yvette, because I want to hear kind of your perspective as well. I don't know, Sarah, if you wanted to comment on that, kind of being this third party that comes in to figure out what questions to ask of portfolio companies. Are you going in and sort of digging in deeply and doing a diligence process, or is there a specific formula of questions that you ask to verify if they're keeping up with specific policies? Curious how you see that.
Sure. So that's a very interesting question. I think the way we're structured currently is that we have the GPs identify what are the metrics that they want their portfolio companies to be reporting on. We haven't gotten to the point where portfolio companies are saying, we are going to set our whole new, we are going to identify what our ESG strategy independent from these metrics that GPs have assigned for us. Mm-hmm. So there is more that top-down approach to defining metrics. I do think that once folks have gone through the process, so we're the platform where that is where the data is being collected and analyzed afterwards. We provide guidance and support for folks who are collecting it, but we aren't doing that verification process. That quality control on our end is more on the platform, making sure that the data is collected in a standardized way. So we have a definition, we have clear guidance on how do you actually measure and calculate it. Because again, I think to Ekaterina's point, there is so much fragmentation just as it is on the standardization of metrics that we're just trying to come up with a single definition and a single way to measure it. And so I think that's where the market is at right now. I really like this distinction of standardization of metrics versus standardization of strategy, and where the US is at versus Europe, because I would like, while right now the space is fully fragmented, I do feel like there is momentum and we're moving towards a harmonization of the metrics. And I think that the strategy, one of my biggest things is it has to be really specific and tailored to the organization and what they're doing, what is their size, who are their clients, and really have this be tailored to their priorities and their areas of impact. So hope that answered your question. Can I jump in, or did you wanted to, was it Lisa that was going to go next?
Go ahead, Rob.
So, it's interesting with it's interesting with ESG and impact and how people look at it. I look at it a little bit differently. So people talk about, if I'm an investor, what's the impact that it's going to be on society, but also depending on how a company performs on a specific, let's say, ESG metric, and maybe let's use health and safety as an example, because everyone can understand what health and safety is, and I'll get to that in a second. If I'm an investor, I want to make sure that I only invest in a company that is very good with regards to performance for health and safety, right? So that's good for the health and well-being of employees and also for society at large. But if a company doesn't perform well with health and safety, what is the risk to that, to the individual business? So let's go use the analogy before. If I have 5 people working in a business and they just do software, not much of a big thing with regards to health and safety. But if it's a mining corporation, well, if they don't take care of health and safety very well, there's a bad impact with regards to individual employees. Maybe people get injured or even die, and that's not good for society with the families that are involved and the communities that are involved. So to me, impact is not just the impact of what it does in the philosophical sense, but really at the ground level with the individuals in the company. Now, again, if it affects the employees, but how does that affect the company? So some companies, if they don't keep a certain level of incidents under a certain threshold, I think it's TRRI, I can't remember what it is, then they may not be able to get certain contracts from other companies. So that actually has a material impact to their business. So not only does it have an impact to maybe them getting more money, but it also has an impact with regards to having their employees getting injured, which affects their families and societies. And those things actually you can track quantitatively. So I think it's always useful to understand what level of impact and where it can apply and what are the repercussions. And again, it's all about managing, because you're an investor, managing the risks within a business. And if you're managing those risks, and we use the example of health and safety compared to a software small company or a mining company, it could actually have an impact, a negative impact if you don't do it properly, to health and well-being of people, but also financially at the bottom line, because again, it costs money to deal with these things, but also it may exclude them from actually getting more contracts or the contracts that they actually want.
Yeah, I think that something to note is that the existing S&P 500 timeline for these existing publicly traded companies to exist on the S&P 500 has accelerated their life cycle from 30 years to down to 10 years. So the existing legacy industry players tend to have this inertia that is leading to their own demise. And I believe that the biggest potential for us to solve these complex problems is through the new emerging companies. And so we're at early stage, we're not over-indexing for risk assessment, we're over-indexing for potential upside and helping to define an entirely new paradigm that will replace the old existing paradigm. Because that is, I think, the most meaningful way to address the climate crisis. We've been chipping away at this ESG and in fashion sustainability issues for over 36 years. And we've moved, an inch in this 1,000-mile journey. We're even more crazily asking for the industry to self-govern and to create their own metrics and rubrics and coalitions, and have put billions of dollars into these organizations that are creating white papers and reports and false flag index metrics. It's not going to be those people that are going to save these industries. It's going to be the new companies that disrupt them.
Yeah, that's really interesting. For context, there was an article in Financial Times that just came out, and it said, investing in ESG frameworks is now the fastest growing segment of the asset management industry. Assets in ESG grew 53% year over year. It's now at 2.7 trillion in 2021. And back in between May 05 to 18, only fewer than 1% of earning calls had ESG, and now about a fifth of earning calls in 2021 mentioned ESG, which is really a huge difference. Yvette, just curious from Meketa's side, maybe could you talk a little bit about what buckets maybe of ESG you communicate to clients, or how do you advise them in terms of like thinking about the different flavors, if you will, right? That might fit within their preferences, or if there's some sort of combination in terms of what those returns might look like as well.
Yeah, so Meketa takes a dual lens approach. We rate firms ESG, like the firm's ESG, as well as a strategy's ESG, to make sure that it's top down across the organization, like implemented, and not just an outlier greenwash strategy that was incepted last year. And then from there, we look at strategies and categorize them in three ways: through ESG integration, which I mentioned earlier is strictly financial for alpha generation or risk mitigation, and then through social responsible investing, or SRI investing, which is more values driven with no explicit return required on that. And then also the third one is impact investing, which is a blend of integration and SRI, where there's a purpose to drive meaningful change while also outperforming a benchmark. So those are the three that we tell our institutional investors about. And yeah.
Do you mind my jumping in for a sec?
Yes.
I think that what we're talking about is ESG as an indicator of longevity. And it's no longer this weird acronym that folks are talking about, but it's actually a tool to assess the risk and the viability of a business. How robust are they going to be? How resilient are they going to be faced in a crisis? So there are numerous studies that have looked at during the pandemic, which companies were most resilient. I was working at Just Capital at the time, and we looked at the companies that had the strongest workers' policies were the ones that were faring the best because they were protecting their workers. And so we've moved from ESG being at the fringe, to your point, to really being at the core of an analysis. And it's moved away from ESG being something that is just wishy-washy and aspirational to this is actually impacting the bottom line of your business.
Well, yeah, it's risk management and material impact, but you could also weight it so not everything is weighted the same. Especially, well, you can have a whole bunch of different variables that you evaluate and see what's going on, but depending on the company, the size, the geography, and the industry, each variable will have more of an impact or material impact than the other, right? And go ahead.
No, just to push on that to Rob and also to everyone else on the panel. I mean, it is ESG, right? It's these three different things. It's environmental, it's social, and it's governance. And so curious of like, when you've been seeing it, like what's the attention? How do you think about incorporating those three?
You know, it's interesting. ESG basically, you could think of it this way to make it a lot more simpler. All the different risks that you could potentially look at and evaluate within your business, people have put into three buckets: E, S, and G. That's where it is today, right? So I wouldn't just get preoccupied on the letters E and S and G, because a lot of them actually overlap to some degree. If you perform poorly in one metric under E, it could also potentially cause a problem in an S. And actually, if G, which is governance, you're kind of performing poorly in a lot of those things, you're probably going to be performing poorly in all the other ones as well. So ESG is, is to me, for some people, unfortunately, a marketing term because they don't really understand what's underneath that. And I think that's where some of the issues lie.
Yeah, and maybe if I can jump in to add to that. So as you mentioned, there has been so many, can you hear me? There has been so many flows into the strategies which are labeled as ESG, right? At the same time, because there is no standard of what ESG means, right? Like we see some of the strategies using basically just minimal additions to reclassify their standards strategy as ESG since it became popular to some extent, right? At the same time, there are managers who have been evaluating this for 30 years and they have a lot of insight. To Rob's point, right? Like, of course, the metrics we look at have to be material to that sector, right? If, for example, banking, a bank says we have cut our carbon emissions by 10%, maybe it's not that big of a deal because they should be focused on like, are they providing loans in a manner which is fair and not predatory, right? At the same time, if the oil company or utility says we have reduced our carbon footprint by 10%, that is a huge deal, right? So, of course, we would expect all of the metrics to be evaluated within the context of the industry where the company operates. But then you roll that up into the strategy, right, an investment strategy. And also, of course, there will be biases between US large cap and then maybe emerging markets, where simply because there is less disclosure, they could be rated more poorly, but it does not mean necessarily that those companies are worse. In fact, you can create more impact because there is more need in those markets, right? And so the ratings overall, the labels overall. Some managers didn't even want to label their companies as sustainable because they didn't want to be pigeonholed into this category. At the same time, they're doing quite a lot of work there, right? Our view is that the more information you evaluate, the better decisions you can make. And that's true pretty much for everything in life, right? So in this case, we have already determined that there is no one size fits all for ESG, but the manager can look not just at pure financial data, right? But also like, how do they treat their employees? Are they following all the laws and regulations, right? And that would make companies less risky in the long run, right? Of course, we have to differentiate also between the different investment horizons here, but also can create more opportunities. If the company, for example, sees, okay, in the food industry, we now see sugar is a huge issue, and maybe regulators will start addressing that. If they start figuring out how they can incorporate that risk early on, that will differentiate them from competitors. Again, this is all very sector relative, depending on the strategy. Different managers choose to focus on different parts of it. I would argue that G has always and should have always been part of the investment process, right? If the manager is not looking at the governance, they probably just not doing a good job at all, right? So what we have observed from our high conviction strategies, it's the balance between E and S, which Rob said, like very well connected to each other, right? And in that respect, we see like there is a whole range of how that could be implemented. And so that's why we see more of classification now and differentiation between different types of ESG. And like, I think that's part of the why European regulation came up with that, because you can assess the data. But then if you say, well, this company is risky, but the return I expect would cover for that risk, do you still invest in that or do you not, right? Like, is your portfolio sustainable? You evaluated information, but did you make the decision to invest based on what's the outcome, right? And so that's where like we need to draw the line between like it's good to evaluate information, but then how are decisions made? And that's how we internally differentiate between ESG versus non-ESG, right? Like, did it change your decision-making process?
I know it's been mentioned a few times about it not being a one-size-fits-all approach, and I think that's so right, because we don't want to turn this into a check-the-box exercise where you just calculate your carbon emissions and you're good, you're an ESG strategy. Investors really need to decide what their objectives or value are and look to standardized metrics to decide what's material for them. And then also remember that ESG scoring platforms vary because they have different methodologies. And so if an investor decides that they're just going to base it off of that one score, they really need to have full transparency into what makes that score and what and an understanding of how it's calculated. Here we kind of similar to Katerina, we don't rely on an individual score, but we rather use it as a starting point to understand the basis and then almost reverse engineer a bunch of scores to understand where the issues are. And yeah, sorry, Rob, I cut you off.
No, you didn't, Yvette. That's pretty cool. So two things. One, so I did evaluation of a company called Refinitiv that does a bunch of different scoring, and one of it they do ESG. And I had a really long session with a bunch of the analysts there, and it was really amazing. So they give us a really good score if you have a policy. So, for example, Facebook has a privacy policy, therefore they give a great mark. But I said to them, so do you actually do any analysis to see if they actually adhere to the policy? Oh, no. So then how could you possibly give them a good mark? So, that's just ridiculous. The other thing is ESG is not only, as we know, about carbon, and the perfect example of that is when Elon Musk threw a hissy fit because he got off the index because he said, well, my electric cars and carbon. Well, yes, but his work practices aren't very good. So, and a lot of his governance issues aren't very good. So again, ESG is, as we all know, is not just about carbon. Although if you've got an electric car and you live in a certain area, and the only place you can charge your car is through carbon energy sources like oil and gas, that's connected to your house, then again, it doesn't really matter. So again, a lot of people don't really understand it. That's what it is. And I agree, there's a lot of rating systems out there that aren't really validated. And I think there's a question there about greenwashing as well, right? On the chat. So that's kind of analogous with greenwashing when companies put information out there that isn't validated. I wonder what fellow panelists think about how we evaluate and proof of impact. What's the proof that we can get, or the validation we can get from the reporting that the different companies put out in the different reports? Yes, of course, they're not all the same because they use different templates or reporting, but that's okay. But it's the individual facts and figures that they show, and it could be, let's say, a certain fact, but is it the right context? Is it the right? Have they cherry picked the information to create a narrative for the benefit of maybe the bonus at the end of the year?
I'd like to touch on that, specifically around the lens of fashion supply chains, because they have been really reamed publicly for the amount of greenwashing and money they put into the efforts to greenwash. We're literally having the industry self-govern and create their own metrics, and then put out their own report cards and say, yay, we're doing so great, aren't we? And then you look at where capital is also being deployed, not only within these companies, the amount of capital they actually put into meaningful ESG investments versus things like, hate to throw it under the bus, but the metaverse. This is just insanity to me. If you really want to look at what matters to people, you'll look at where they're putting their money and what they're measuring. And the industry and investors in the industry for the metaverse fashion alone, just in the past, I think it was 2021, something like $30 billion was deployed into metaverse virtual fashion. Virtual fashion, woohoo, NFTs and virtual try-on in the metaverse. And it's the new shiny object that allows the industry to deploy a ton of capital, and a lot of VCs that don't really understand the moving parts and complexity of this industry. If you really want to create something that is going to create long-term, viable, real-world value, as opposed to a quick flash in the pan, money laundering scheme with NFTs. That's my personal opinion on a lot of what's been going on in the metaverse. You will invest in circularity. Circularity is literally reusing the same asset over and over again. And it takes a lot of effort to actually put through the systemic thinking and processes and collaborations needed to drive circular infrastructure. But if you actually do the work, you can have a far more profitable, localized, circular, on-demand model. It just requires your focus and intention and investment. So HSBC, I think it was BCG and Fashion for Good in 2020 put out a sustainability report around the amount of capital needed to be deployed just in early stage fashion supply chain innovations every year between 2020 and 2030 for the fashion industry to hit the sustainability goals they've set for themselves. And it was $20 to $30 billion needed just in that pre-seed and seed every year between 2020 and 2030. And to hear that 30 billion in 1 year went into the metaverse fashion, we're barely maybe in the hundreds of millions of dollars currently being deployed into early stage fashion supply chains. So I want to again reiterate, you're telling me what matters to you. And if you're aiming for hitting, incremental, good enough metrics, then you're already failing, in my opinion.
Maybe just to add to that, and unfortunately, I would have to jump, similar to what Lisa was saying and what to answer Rob's question, right? What we're looking for is the progress over time, right? If the company says, or the investment manager says, this is important to us, let's use carbon as one example, right? They may have whatever commitments they want. Commitments don't mean much in general, right? Because there is no necessarily any enforcement mechanism. So how do you hold them accountable? Nestle has been promising to eliminate child labor for 30 years. They still use it, and now nobody bothers them, so they stopped promising altogether, right? So we see a lot of commitments made with respect to carbon now. And what we would like to see is, well, how have you improved from last year? If you say this is important to you, right, then what progress have you made? What Lisa said, like, have you invested in this, right? And have you actually made progress, or have you actually started emitting more carbon, hoping for the better future outcomes miraculously to take place, right? So metrics we want to use, and again, like I say, metrics very specifically, not ratings, because ratings have a lot of subjectivity to them. We want to see specific metrics and progress over year over year. And it will differentiate between different strategies. But like, if you as a manager or as a company say this is something you focus on, show us what have you done, right? Like if you say we are diverse company, right? Like, okay, what has been your progress? If you say we have better health and safety policies, right? Okay, well, have your accidents reduced over time, right? So depending on what you're saying, you manage and prioritize. We want to see specific data. It does not have to be too overwhelming. There are probably very few data points which are important for each industry and each company, and then show us how have you been progressing and where you stand relative to peers. So I'll stop there, and unfortunately I have to jump, but it's been such a pleasure to join the panel. Thank you, everyone.
Thank you very much.
Great to hear you.
Thank
you.
I agree 1,000% with Ekaterina. You have to not only show me how much capital you're deploying to those initiatives, but show me how you're measuring your success.
Yeah, it's interesting. So if somebody makes an investment, one of the ways they do that is to come up with a value of the company and divide it by the outstanding shares, and they figure out what a price would be, and then they'll say, okay, this is what I'm prepared to pay for, right? When it comes to ESG and investing, if that's important for people, I know it is for a lot of people in this panel, but do they do the same process and come up with a certain benchmark that if it goes over a certain benchmark, well, it's over what I'm comfortable with? It's really the methodology or the philosophy is actually the same thing. I do that, or the people that I advise, if you're looking at a company, if you set certain thresholds or and benchmarks for certain variables of whatever you under ESG, and if one is not as satisfactory enough, then you say no, which again, it's are they positive with regards to this in an impactful way? And on the other side, is it negative, meaning it doesn't reach the threshold that I've set? I'm just curious what everyone else thinks of that.
Yeah, and just to reiterate, I guess what you're asking, Rob, how do we make those decisions, right? What either benchmark or to make those ESG impact investments? Yeah.
So, for example, if you're an investor, the person who's making the investment makes their own decision. What is the price of a company or an investment that they're comfortable with, right? So if if a company's were if the company, if you do the analysis, you think it's worth $50 million, but yet on the open market, it's worth $1 billion, we might say, well, I'm not going to buy that because the ROI isn't really not there. The economics doesn't make sense for that price. But if tomorrow the stock market crashes and now the company is valued at $25 million, so it's now it's less than what you actually evaluated for, and the business is solid, then you might buy into it because it's now reached a certain thing, a price that you're comfortable with. Same with ESG metrics, or if there's certain risks that are under ESG that a company's underperforming, then you might say, well, you know what, based on what I think it should be, and we talked about, health and safety, it could be anything. It could be quality control with the components, or it could be sourcing and using slave labor, whatever it is. To me, it's the same philosophy and methodology as opposed to evaluating company and the value as opposed to any other the different variables that you're looking at.
So we do assess value, current market value, obviously valuation, but we tend to over-index on our own personal insights and assessment of where the industry and supply chains are headed. and if their trajectory matches with that directionally for sustainability, impact, diversity, all those things as well. But it's really useful to have an overall conviction around what the future of supply chains will look like, and inherently baked into it is ESG, for us anyways. And to invest in the earliest stages, having that conviction of directionality helps us to understand, okay, everyone else might not see the value in this, and we can have a conviction to invest before everyone else and help the rest of the world to understand the value of that emerging innovation.
I'm conscious of time. I want to leave it maybe to Sarah and Yvette just to say kind of their last comments on, how should someone be thinking about, making investments in ESG and impact investing. I think we heard from Rob on having sort of this threshold, on Lisa in determining trends of where things are going and having conviction on those investments. Curious on what thoughts you have on that.
I was just waiting. So I think the idea is identifying what is at the different stages. So if you're a GP, what are your corporate values? What do you want to be prioritizing? Because obviously you can't focus on everything. And so from there, kind of devising what is your ESG strategy, identifying what metrics you want to be tracking. And I think that one of the last points that a few panelists have made is policies are only one part of ESG. And I think that we operate within an ecosystem. So you need to have these safeguards. So you have organizations that have curated data sets that track performance on specific topics. So you have RepRisk, for example, that tracks in real time whether or not there are allegations of breaches of these policies. So having the policies are great, but if you don't have the mechanisms in place to enforce them, or if they're repeatedly failing, then they're not worth the paper it's printed on. And I think someone asked a question about regulators, and I think that they play a heavy part in both setting the standards. And so what are baseline metrics that everyone needs to be reporting on and thinking about? And so that is D&I. I think that's workforce safety. And I think that you have environmental concerns that should be core to every single organization. And then the enforcement arm, which is something that we're starting to see now, which is the enforcement arm of the government coming after folks who are misrepresenting, they're calling it fraud, the progress that is made, or if the budget doesn't align with the strategy, or if the strategy is not met with budget. So I think that knowing that we operate within an ecosystem, being grateful for each part of it, and identifying and how relevant each portion of it is, and then making sure that the metrics that we're looking at, we're not only creating like a benchmark assessment, but also setting targets and to Lisa's point, giving the budget needed, allocating the budget needed in order to meet those targets.